Hey, so welcome to our first kickoff session. So we're going to start out talking about derivatives at a very 101 level and provide a solid foundation for the rest of the day to spin off. So first of all, if you missed my previous introduction 2 minutes ago, I am Christina, and I work for Vega, and I'm actually kind of a recent, actually philosophy graduate, and regrettably a fairly new derivatives fan. And I've been very fortunate to learn a lot from Tamlyn, and I'm very glad that we now get to expose that knowledge to more people alongside Bobby as well. So first, I'd love you both to introduce yourselves and kind of how you got into capital markets and what your field within that was and what markets you traded and maybe what was your favorite and what was your least favorite, if that.
So yeah, I got into markets. It was kind of funny. When I was at university, I went to the library once and I got a video out, because back then it was videos. And I watched the Chicago, I think it was the pits in Chicago, some crazy trading going on there. And I thought, geez, that looks really fun. That sounds like something I'd want to do. Even though I have it's typically very soft-spoken, I don't think I would have actually survived trading in the pits. But I was really drawn to the kind of type of maths that was used in financial markets, and I'm quite a competitive person, so I thought this would be a good thing to explore. And when I left university, I'd done a master's in financial maths. I quite sort of by chance ended up getting a job in the power markets, and I didn't even really know about the power markets. They kind of exist in a way that most people don't really know. You turn the lights on, you expect power to arrive, and you get cranky when there's a power cut. But basically, you don't realize actually how much financial, really complex and really awesome financial market infrastructure is going on to deliver that to you in the lowest cost possible way. So I got into the power markets. I loved them. I learned a lot. I saw a lot of change during the time that I was in them, because I was trading pretty much pushing 15 years. My favorite market to trade was probably the weather derivatives. They are just mental. I mean, the power markets at the time I was trading them were, I think, the most volatile markets in the world, and they were pretty crazy. And then I met the weather crew, and I thought, wow, they was just, storm chasers turned financial markets experts. And, obviously weather is highly dynamic and highly volatile. So, that's my background. That's my favorite market. But I obviously now love crypto and DeFi.
That's really nice. So I'm going to go next. First of all, thank you for having me here today. It's really nice to be here. So my name is Rafaella. I'm from Brazil. And I'm from the countryside of Brazil, and I went to São Paulo to study business. And I think that my college in Brazil has a very strong background in investment banking. So everybody that goes out of there, or most of the people, go to investment banking careers. And so I kind of did that too in the beginning. So I went to several different areas in the financial system in Brazil, and that would be sales and trading, and then family offices. And then I also went to back office one time in a hedge fund, and then trading desks in an investment bank, in the largest investment bank in Latin America, that is called Itaú BBA. And there I was living my dream, which was I was working at the trading desk at that largest fund, largest bank. And we were trading their credit and structure products. And so I thought it was amazing at the beginning, but as time passed, I got a little frustrated with the technology of the bank and how things were executed and done. You might need, like, I don't know, 5 to 10 people to close one ticket from different areas. And so that got me very frustrated, even though I still loved credit and structured products. For instance, I think that my favorite market would be CDSs and bonds, like sovereign bonds. I think that's really nice. It was my favorite thing when I was at the bank. So, well, then I left the bank because of that, because I thought that technology was still pretty archaic back then in the banks. And so I left to find out what would be the technology that could actually help that infrastructure be better. And then I found blockchain and crypto, completely fell in love, and here I am now.
Nice. Thank you so much. So even in your introductions there, you guys have touched upon a couple of what seems to be different types of derivatives. So could you maybe explain like what differentiates the different like one derivative product from another, and how would you even know that you kind of need one, and how would you go about getting them? Whoever wants to start.
Yeah.
I don't mind. Yeah, sure. Okay, so I'll just say, what I think the thing about derivatives is they're basically an agreement. They're to trade out a risk that you have. So say you are subject to some kind of financial risk, and we live in a world where things change all the time. So supply and demand is changing, meaning prices of things are sort of inherently changing. And basically derivatives allow people to smooth out that crazy price movement by locking in sort of prices ahead of time. And really, when you boil it down to, actually, I think David, who's speaking next, Alquan, he always talks about like trading promises. You're sort of saying, okay, it's not just the here and now, let's swap some cash or some money or some assets. It's like, it's what's going to happen in the future that I'm worried about, and all that uncertainty. And I don't really like uncertainty. I mean, humans don't really massively like it. And in fact, the proof of that is that derivatives have been around for basically as old as writing, really, or written law. I think maybe the first written derivative was recorded in the sort of Babylonian times, and it was an agricultural derivative. So, like you talk about sort of hedging corn futures. Yeah, this was basically an agricultural derivative that it basically got somebody out of needing to pay their mortgage, which their mortgage payments were paid in the crop they were growing. And if they didn't, if their crop failed that year, they didn't need to pay it. And then about 1,000 years later, Aristotle also wrote about derivative. And it was a little bit more of a speculative one, where a philosopher had basically figured out or decided, I don't know how, that it was going to be a really good olive crop the next season. And so he went around in the winter and he negotiated with all the olive farmers to rent their presses and agreed the price ahead of time. And then when the demand surged, he was right. He was able to then lease those presses to other people and make a profit. So that's more of a sort of speculative derivative. So yeah, it's very, I would say it's a very base human, it feels a very base human need of increasing certainty.
So but could you expand a bit on the difference? So there's a difference between needing a derivative and having a risk to mitigate and speculating on one.
Yeah, do you want to take that one? Rafaella, I'm happy to.
No, go ahead.
Yeah, I guess, yeah, how do I say this? If you have a natural risk, so you have an asset and you want to protect that asset from maybe major devaluation or whatnot, then you want a derivative to protect that asset. Whereas in the olive farm example, the olive press example, he didn't have an asset to protect. He was designing something because he had a particular risk appetite and a belief, and he wanted to express that belief in some way or another. Perhaps you could say he was hedging his need to have money to support his family or something. That's a more sort of typical speculative example.
No, that makes sense. And could you talk a little bit about the different types of derivative products?
Yeah, of course. So when you're talking about derivatives, you have like all different sorts of things that you can do. So you have forwards, you have futures, you have options, you have swaps. In each one of them do something kind of different. And most of the differences are like, I would say, in cash flows as well. So in how you trade and what is the underlying asset. So for instance, what we do at pods are options. And essentially what an option contract is like, I want to try to say that in a very easy way. So it's like just a contract that you do with someone else that allows you to do something in the future. You have the optionality of do that or not in the future. So it's like buying, like when you buy insurance for your car, you have the optionality to use that insurance in the future or not. So an option could be seen in a kind of the same way. And like each one of them has like different ways of pricing and actually executing in the market. So if you think about like options have a very specific way of being traded in traditional finance. And this is like at this point completely different than DeFi at this point. And some people may even look at options in DeFi and say that they are not even normal options because they are not. They're very different at this point. So Tamlyn, do you want to?
Like, what makes it so different?
Okay, so one of the things that you can think of DeFi is that it's completely transparent and like decentralized. And in order to be decentralized, you have to make sure that you're not going to have a counterparty risk. So you're not going to end up not having the collateral or the margin to offer to the other part. So you require the one side of the trade to put up 100% collateral or 100% margin. And for instance, in traditional finance, this is almost bizarre because it's not how they work. Normally, they work with like 10% margin or even less, depending on what is your type of like account inside the exchange or the clearinghouse. So what we do here is like 100% collateralized options. So there is not real leverage on this. And this can be very capital inefficient on the perspective of allocating capital. But I don't want to get too complicated. If this is going too fast, let me know. But so DeFi needs to have at this point 100% collateral, which is not very effective for traditional finance. But it still allows someone to agree on the optionality of exercising a right in the future, which is interesting. It's like the beginning of derivatives in DeFi, I would say.
So that kind of touches a little bit on something else that I'm wondering, which is why have we seen such an explosion and growth of derivatives, not just in crypto, but in general? Is it because crypto markets are so volatile, or is there, I mean, of course, there's more uncertainty in the world right now for reasons I don't need to mention, but even pre-pandemic, it was just an ever-growing market. Why is that?
Okay, Tim, do you want to take this one? Do you want to start? No? Okay. So I would say that at least in crypto and DeFi, like the tools for doing that are being born right now. We're just starting with that right now in DeFi, I would say. So I think that's why the interest in this area in DeFi is growing, because now it's actually possible to do that. Before it wasn't. And I would say that even if it's possible right now, it doesn't mean that we are actually attracting like people that were trading derivatives in Deribit, for instance, or other crypto platforms. And also, like, I would say that it feels a lot like you could even seeing this as like people, since there was not too much liquidity happening on those places. People that understand derivatives saw that there were spreads and they could arbitrage those spreads, so they started like looking into this more carefully. And probably there is also a macro situation related to this. If Tam wanted to take this on.
I was actually curious, are you guys talking about just the crypto world, or are you talking about just globally generally?
Globally and generally.
Oh, right. Yeah, cool. Yeah, sure. Yeah, I can't speak too confidently to that, except to say, like, I've watched, say, like the growth of index equity options in India, for example, and I think that's my sense of this is that the people in general are becoming more financially literate and more able, perhaps through even through sort of internet finance and web-based kind of access to exchanges and so forth, to understand and participate in the financial markets. But yeah, that would be my sense of things, and I don't really have too much more to say on that. I'm not a sort of expert in sort of the global growth of all the different markets, but it's definitely been something I've watched. Like, for example, SMEs, there's been a huge growth of small, medium enterprise over the last decade, and small, medium enterprise has a lot of risks in their business, processes, and these risks are not things that they are necessarily, it's not their core business. If you're growing coffee or and you need to export that coffee, you don't want to have the concern about the sort of economics of the whole world and what kind of exchange rate you're going to be dealing with if you're receiving an alternative currency. Just isn't about where your expertise necessarily is. And so I think with the growth of SMEs, we're also getting a growth of derivatives adoption and usage. Although sadly, SMEs are still charged something like 40 times what an investment bank might be charged for trying to do the same derivative. I think, Rafaella, you saw this actually in your
so that kind of brings me on to something I wanted to ask. So for example, I studied in the UK, but I got my student loan from Norway. But when that was calculated, the currency exchange was set, like the kroner to the pound was set at a certain level. And then it actually dropped 40% by the time I had to pay. So like, for example, that would be a risk, but I mean, I'm not an SME, but as an individual, like, could I have gotten a derivative or insurance for that somehow?
Yeah, I would think so, definitely. That, that's exactly the kind of forward risk that a derivative is really just perfectly good for hedging. And by hedging, I mean protecting you from that movement so that you stay whole no matter what. And there are different ways you could have done that actually, but as Rafaella talked about earlier, you could have bought an option that gave you the right to lock in a specific exchange rate if like you could have sort of decided what the worst exchange rate you could handle was. And bought that. You might have had to pay a little bit of upfront money for that, and then in response, you would have had that guarantee, the worst exchange rate you get. That said, I say all of that is theoretically how you should do it. Where you would actually get the ability to transact that at a decent price is debatable. There are sort of retail exchanges where you could do something, but you'd have to look quite carefully that you weren't going to say get closed out. You'd have to look at the leverage that you were taking and just make sure that your hedge was going to be there for you at the end of it.
Because you talk about, and I know this also, from Marx, you talk about finding a price. Like, how does that actually and when you say that something is more expensive for SMEs than an individual, like who sets those prices and who sets the fees?
Yeah, really great question. And there are so many different ways that derivatives trade. There's all the way through from like direct, like you call someone and say, I mean, in your example, had you been able to call someone who had the opposing problem, maybe another student that was worried about going to Norway and was saving in British pounds, and you guys could have sort of agreed a side deal, and that's a derivative, right? And said, okay, we're going to agree what exchange rate we're going to lock in. So there's sort of direct sort of peer-to-peer trading. There's markets like the over-the-counter markets that you're often heard talk about, OTC markets, and these markets are a form of that kind of direct trading, but often also broked. So have brokers that facilitate between banks and individuals and businesses who might want to trade it quite standard, like they've pre-agreed a sort of standard type of contract or type of derivative that they want to trade. And then there's also exchanges like, the CME, for example, and, a whole bunch of global exchanges that also list products or contracts, derivatives contracts, and they're tradable on that too. But I was thinking back, actually, the reason I laughed when you asked that was back when I started trading, the way that I would get a price, I was trading swap contracts, and there was a broker, there were brokers in the markets. And the way I would get a price was I'd have these speakers, these kind of big speakers that would sit on my desk, and I had about, they're called swap boxes, and I had about 8 of them. I had brokers shouting down at me all day, every day, telling me their prices, and they would also get a screen on Reuters. They would sort of rent some space on Reuters, and they would put their prices, and so I could see their prices. And when I wanted a price, I would press the button, and I'd go down to them and I'd say, hey, I want to take that price, or I want to give that bid, or whatever. And the broker was essentially like a matching engine. They were the ones deciding who got the price. And, sometimes they'd be like, oh, no, that price is gone, or, and they had kind of full discretion over whether I got the price. And if you got really cranky at your broker, it was a big deal, but you'd pull their line, you'd literally pull out the plug and say, right, you don't get any of my business anymore, and you'd throw a little tantrum. But yeah, it's kind of funny. That was how prices were done in the sort of early days of the power markets, and then the exchange listed contracts, and then that was sort of more transparent, let's say. So, way.
I have a question. Good question. Tamlyn, how do you think that this is going to change? When you were talking, I had the impression, and I also remember from the things that I experienced in my life, that it was pretty much siloed, like the U.S. market, Brazilian market, the UK market, and then you have those brokers that are sometimes doing it, like the connection between them. But it feels that like we're moving into a very global technology world where you're building this infrastructure. How does the figure of that connector in those like price discovery mechanism change in your perspective?
Yeah, it's a good question. I think different markets suit different price discovery mechanisms. So some markets really suit, say, auctions. So like you might have like I think Chicago Booth academics did some really good research on looking at which price determination methods, or I think they were specifically looking at auctions, actually, like how fair that was compared to like a limit order book that you find typically on an exchange. And yeah, sort of, I suppose the less liquid derivatives markets would, the sort of voice brokered or the auction price determination methods could work quite well. And I suppose the equivalent, a global equivalent of a voice brokered one might be some kind of, global RFQ market, or, some sort of, like less liquid determination method than a limit order book, which is what you typically see on an exchange. I think that all these price determination methods, I think the markets need to be able to choose the price determination method that works best for them. And actually that's the model that we've gone with at Vega. And so we have, we'll be launching Vega with both a limit order book and auction mode, but also, looking at, thinking about AMMs down the track and other different price determination methods. And we're building it quite modular for this reason, because I think it really depends on the market, and markets can change over time as well. As they can start liquid, or they can go through periods of illiquidity and liquidity.
Yeah, interesting.
Yeah.
Cool. So just to bring it a little bit back in to our 101 session. So now, so say that I, as an individual or an SME or a larger corporation, have acquired a derivative. How do you kind of know that you have it? Do you kind of get ownership of it? And can I, like, for the ones that have an expiration date as well, could you resell it, or like how does this work?
Do you want to talk to this, Rafaella, or do you want me to?
I can talk definitely about the DeFi world and how that works. And then maybe Tamlyn can talk a little bit about the traditional finance, how it works. So in DeFi, especially with us, for instance, if you buy an option, you have it in your MetaMask. Like, you have the ownership of that right, and you can take it anywhere you want. And then in the future, if you want to, you could resell it. You could maybe put it back to the pool where we came out. And then you could also keep it until the expiration and then maybe exercise it or not. So you basically can see it there, and there's a price associated to it, so you can basically track it very easily with your MetaMask. Now, with traditional finance, it's a little different.
Yeah, well, actually, traditional finance, I mean, derivatives are often, and I may have even used the terminology earlier in the chat, often referred to as contracts, because, there's this agreement, this promise, but how do you know that that person is going to turn up? I mean, with your student loan, if you'd matched off with someone in England, but how do you know that they're actually going to fulfill that and agree and not just leave you stranded? And so in traditional world, there are contracts that govern it. It really depends on the way that you're trading as to what type of contract. But for anyone who's interested, it's worth checking out like the international swaps and derivatives association, ISDA, and that is a industry body that has helped establish sort of a generic contract template, let's say. And then like when I was trading and a participant wanted to trade with me, I would pre-negotiate this ISDA contract agreement, and then after that, and it would define the contract and all the obligations in it. And then after that, we could very quickly and easily, the broker could match us up, like I was talking about earlier, very quickly and easily. And then, of course, on exchanges, you have essentially the rules and the mechanisms of the exchange, and you essentially have contracts with your clearing broker that talk about everyone's respective obligations.
Would your relationship with the broker affect that?
So the relationship with the broker definitely affected how good prices I would get, or
yeah.
yeah. But no, once the deal is done, actually, what would happen is that we would get onto a recorded line, and then we would confirm the deal, and he would tell me who I've dealt with, because I wouldn't have known at that point. And then I'd have to write out a deal ticket on carbon paper. And I'm going back 20 years. And then I would, sort of tear off one bit of it, and then the risk department would pick it up and take it to the middle and back offices to sort it out. But what those middle and back offices did was process and fulfill the obligation and make sure that the other side was fulfilling it. So yeah, that's sort of how it works typically in the traditional world. You can also just have contracts that are bilaterally agreed, and especially some of the more complex structured products. Like I think some of the contracts that I negotiate are just hundreds of pages, because they're all about if this power plant comes online at a time when the weather is this and the gas supply is this, and there's all very complex kind of triggers that were going into the option, the optionality of the contract. So that would take sort of extensive and bespoke contracts.
So something that you touched a bit on there is, fulfilling the counterparty here. So, because of course, part of what can happen is that something that you I don't want to say bet, but something that you predicted or hedged yourself against can actually happen. So if that happens and I'm owed money, like how do I know that? And how do I get that? And is there a fee on that? And how do I know that they're going to honor that? And it would be great as well to understand that from both a DeFi perspective and a traditional perspective.
Yeah, sure. Well, I'll just cover it quickly from traditional. I mean, there's obviously the sort of last resort is to take an entity to court and say you owe me money, and obviously that's expensive and undesirable for everyone. So what people tend to do is try and put in a lot of sort of things in place to try and prevent that. So one thing that they'll do, and this is what credit rating agencies are good for, is they help you understand what the counterparty risk, like how likely your counterparty is to default. And so then part of your middle office and risk department's job is to be continuously assessing the composition of your credit risk. Like, actually maybe it's better for you to not only trade with the one entity, because if they go down or something bad happens to them, all your contracts are, they're in a bad place and you're going to have to fight for the value. So yeah, sort of diversification principles obviously apply. And on exchanges, what exchanges do is they basically, and there's a mechanism that a similar mechanism can be done in the OTC world as well, and doing swaps. But basically, the idea is to say, like, on the day that we dealt this trade, it has a fair value that we both agreed. Now, the next day, maybe the price has moved. It's not the same price anymore. So one person of the trade is what we call sort of out of the money, or they're losing money on this, as in they've sold something that is now worth more. And so what an exchange will do is, first of all, it says, okay, there's a potential, we don't know on the day that you.
She left the stage.
Oh, I think maybe she lost connection.
Yeah, I think so too. Well, do you want to talk a little about how you would do this in a decentralized way?
Totally. Well, she was just talking about something super nice, which is marking the positions to market and then having to put up more margin as collateral. And this is completely connected to what I was going to say around DeFi, because in order to, in traditional finance, one person or one exchange is able to require more margin for someone. Oh, she's back.
Sorry. I could hear you guys the whole time. I think I messed up with the link that I joined with, so apologies.
No worries, go ahead.
Oh, sure. I'll just very quickly finish then. So the exchange will go, okay, this price could move and we don't know, so we're going to charge you an initial margin. So you're each going to put some money in, and it's sort of held in a, like, let's call it an escrow or like this account. Actually, the exchange holds it. And then the next day, they figure out who's winning or losing, and then they do what we call mark to market. And so they will take the person who is losing, pays basically the amount that the contract has changed in value into this pool. And and the person who's winning kind of gets a little bit of credit to their account, broadly speaking. And so what they do is they have very sophisticated risk models to decide and figure out how much can this contract move in a day, and then not just this contract, but all the contracts you're holding, because people will often trade a portfolio of instruments on an exchange, and so it's not just this one contract might move, but your portfolio, how much will it change, how much risk because for an exchange they are acting like a central counterpart, as in they are the ones. So if I did a deal with Rafaella, and you're the exchange, Christina, we've actually both dealt with you. Like, you're actually we call novate the deal, and you're actually guaranteeing this trade. And we don't even know the identity of each other. And so it's actually you that bears the credit risk. If I disappear, you still have to, pay Rafaella. So it does make for a really fun challenge in DeFi. But I think we're really excited because we feel we've designed a way to run really sophisticated risk models on chain and offer the same, even better capital efficiency than you get in centralized markets. So, but yeah, more on that later. But
could you just give like a nice introduction, definition of what does it mean to be capital efficient?
It's a good point. It just means you need to. It's not quite being cheaper, but it's like you need to deposit less. So those deposits where I said the exchange charges initial margin, you have to put deposit on. It doesn't mean that you're going to necessarily lose that money, but you have to have the money and put it on hold, and you can't go and use it somewhere else. And the extent to which you can use your margin elsewhere depends on the exchange.
Okay. That was good.
Yeah. It's how expensive it is to sort of do the deal for the trader.
Okay, cool. Do you want to talk a bit about how this is done or return to what you were starting to talk when Tamlyn disappeared?
Yeah, of course. So Tamlyn just described how margin requirements work in traditional finance. So that the two sides of the trade has to be like looking at their positions and then maybe adding more margin. In DeFi, this doesn't happen at this point because it's really hard to. First, you don't know who your user is. You can't track them down. So second, there is no way I could allow try to send them a message and hope that they will come back to put more margin if they need to, right? We just can't do that, because otherwise there is no way we could back the other side of the trade. So I think that a little differently from what maybe Vega is doing, which is being decentralized counterparty, we're actually letting them trade between themselves. In order to do that, at this point, you have to require 100% collateral initially, which is actually terrible for capital efficiency. Because as Tamlyn said, that you have to let your money park there and wait until expiration before you can do anything with it. So one way to reducing that capital inefficiency is to actually allow that token that is parked there to be an interest-bearing token, so that this token is generating interest on itself. It's like if you have a bond inside of that, you know. So this is just a way to, you know, get back a little bit of that, but still is inefficient.
No, that makes sense. So when you say, you know, top of the derivative almost.
You could think of this as a kind of a structure product on the seller side, because you add like a bond, which is this interest-bearing token, and that could be, in our case, is a token, meaning the token from Aave that was supplied as like lending. So you have this A token inside your option, and then you mint that position, and then you sell it on the market. So what you have is an interest-bearing token with the possibility of being exercised on a certain strike price and an underlying asset. So that is like a package of a position, basically. You could think of that like that.
No, that makes sense. Thank you. So for people who are actually, something I want to ask about as well is just the risk that comes with trading derivatives, and you know, you often hear about people trading with a higher risk appetite than they perhaps should have. What are the kind of rules or guidelines or something that you'd recommend to people who are just starting to getting into this? And also if there's like any resources or favorite things that you guys would recommend.
Okay, I could suggest one thing from start is that trading derivatives in traditional finance, as we said, is very different at this point from trading derivatives in DeFi, but still both have risks. So I would say that if you're just starting, especially in the case of options, don't sell an option at this point. You can buy options as many as you want, but if you don't understand it very well yet, don't sell it. And research more, understand the risk that comes with it, understand what is exactly the position that you're trying to do, and what is your intention with using this tool. Because remember, this is a tool, right? You're going to use the tool to build something, to do something, right? And know what is it that you want to do out of it, so that you can choose what is good for you. And study a lot, I would recommend. I don't know, maybe try to talk to someone that also understands about this, so you can, you know, sanity check what you're doing. I think it would be a good start, and being very careful about selling options, I'd say.
Yeah, I was going to say definitely a strong focus on risk management. You know, traders in the traditional world are typically really good at risk. They understand how to think about risk. They look at all the possible outcomes from as many different angles as possible. They model things, they scenario test, and they really stress test what might happen. So yeah, learn about payoff diagrams, read Hull, and definitely come to David's talk, which I think is next, because he is a guru in risk, and it's basically a free lecture from a university professor who's a guru in this. So.
Well, that's a great way to wrap it up. Also, I will be asking you guys to share the resources with me, and they will be shared in the interactive report that this whole event is going to culminate in. So everyone that was wondering about that. Now you know. Thank you so much. This has been lovely. Yeah. So we'll see you soon in 4 minutes for David's session.
Great. Thanks, guys. That was super fun to chat to you, though.
Thank you.
Thank you.